In terms of disappointing deliveries from Tesla, how should we think about that, given the fact that you had this drop in the tax credit? I think there was an expectation out there that we would see a pull forward in Q4. We didn't get it. How worrying is that?
Well, what's worrying is that what if you did get the pull forward, right? And that there were extraordinary efforts in awareness and reminding prospective customers, hurry up and get your order in before midnight New Year's Eve, or the tax credit gets cut in half. And so that certainly would have helped volume. And in spite of that, they still missed, not by a large amount, folks, right? A couple percent. But then you tack on the discount of $2,000, and we have this, for the first time since the company's been public, a very conspicuous move to where you're kind of sending the message that perhaps incremental demand is not as strong as incremental supply for this company.
So what's the bigger worry here then? The price cut or the delivery miss?
Both. They both hit on a product that might have achieved a very high level of delivery in the fourth quarter and could drive very strong cash flow that could be at least as high as what we saw in the third quarter. The question is early 2019 the moment where we see the difference between what was achievable and what's sustainable? And perhaps what's sustainable this year is not as high, and we're several hundred basis points, about 400 basis points of margin lower than consensus for our 2019 forecasts.
We're very focused on China right now, given the cut guidance from Apple. Is this something that's going to play out in Tesla's earnings as well?
Not just Tesla. We think that the Apple profit warning should send a message to all investors involved in global autos, okay? The thing that Apple and the auto industry has in common is China is a massive market for them. It's about 1/3 of global auto demand. It's about 1/3 or more of global auto supply. It's created tightness in supply and demand for the last decade or so. And it's one of those contributing factors that we think is going to make the run-up to the Detroit Auto Show in a couple weeks very sobering. And we think that the Detroit show is going to be kind of an all-you-can-eat buffet of potential profit warnings from suppliers and OEMs alike.
Adam,
focused on China.
Is it just China? Because in Apple's commentary, it seemed like there was some sensitivity to premium pricing in other developed markets as well. I don't know if that reads through into the auto sector also, or is your focus really China?
No, sure it does. China is the tip of the spear, but we're talking about the auto industry is the quintessential global supply chain. And so any interruption of global trade, be it in North America, with Europe, with China, it really gets magnified in the auto industry in terms of input costs, cost of doing business, where you're investing. And we think that there seems to be this kind of auto corporate referendum kind of to the administration. Hey, look, thanks for some of the help you've been trying to do last year, tax cuts, et cetera. But some other stuff might have gone too far, and it's hurting our business. You're poking some of our biggest trade partners. It's hurting our supply chain. Oh, and while we're at it, message to the Fed, this might be the first year in 9 years that global auto production doesn't grow. We really want to keep raising rates. And so I know that that's apparently priced in as a neutral here, but the auto industry might use Detroit to send some messages to the auto credit powers of please keep the taps open or else get ready for a major slowdown of the base that supported the administration.
Adam, we're getting auto sales here in the U.S. and North America as well today. Are these drops as expected, or are we seeing more pain in this market as well?
December, the comp was very difficult. The December selling rate looks like it's in the low 17 millions. It's pretty strong. The worry is this industry for 2019, for the first time in a decade, doesn't grow. And when you go X growth, when you go stall speed in global autos, that's when you can't price, your incentives tend to rise faster than your production, your costs of doing business go up, you can't pass it through, costs of funds and acquiring cars via credit, those financial instruments, that becomes harder, and we see risk to numbers. And we have a note out today where we think consensus, to be blunt, is just way too high. Consensus still has auto margins growing, folks, into a stall speed year. We're saying get those numbers down, and we think that the next couple weeks is a perfect opportunity for the auto companies in unison and with a lot of sympathy, including from Apple, saying, hey, get these numbers down. And then that needs to happen before the sector can start working again.
Specifically on the U.S., Adam, you're sounding very negative. So are autos a canary in the coal mine for the broader U.S. economy, which is something we've been asking all year? Or is there something specifically structurally going on where Americans aren't buying as many autos? Because you mentioned it should be a message to the Fed and to everyone else, to China. It's unclear how much is macro and how much is auto industry specific.
If you know, the automobile is the second biggest purchase outside your home. 95% of autos are bought through financial instrument, loan and lease, employs millions of workers and dealers and suppliers and auto factories, okay? 1 in 7 to 1 in 10 jobs in the United States are related, either first or second degree, to the auto industry. And so, listen, you can look, I'm not speaking on behalf of the broader economy, but if you extrapolate the comments I just said and you look back at correlations between interest rates and auto employment and the broader economy, there are correlations. So you can do your own extrapolation on that. I'm not going to disagree.